Hello everybody, Rick Melero here with the HIS Capital Group. Today we're in a boardroom once again going over some numbers on a property, but this time this is a property that we recently acquired. We're just rerunning numbers to show you an example because we're actually going to be in this property and show you the work that we're doing to improve the property's value. In this particular project, I'm actually looking at the HUD right now. We'll talk about how it was negotiated later, we'll go through all those details, but right now what I have on the HUD is $67,500. was the actual ultimate purchase price, which I'm going to include here. So we're at $67,500. This particular property, when we did an analysis, we did two actual rehab bids. One of them was one we used to negotiate with the actual seller. We'll talk about that later. The final one that came in was basically $11,500. So that is the actual budget that we incorporated into our numbers when we figured that we were going to sell this property. Now, based on that renovation and those improvements that we were going to contribute as an investor, we did a full analysis that gave us not only a BPO, but actually we ran some numbers to confirm that the BPO was accurate. And in that BPO, we came in at a value after our repairs of $109,500. And that is the actual figure that we have. Now, what I'm going to do real quick, just so that I can show you again whether this is a good deal for us or not, I want to basically get 100% of the cost. Now, carrying costs generally run about $2,000 to $2,500 depending on the actual timeline of the deal. But because we understand this market, we do quite a bit of volume here. It's usually we plug in a number because we already know based on history what we've actually been able to accomplish. So what I'm going to basically do here is just run some numbers real quick. Give me a total cost of $81,000. That's including my carrying costs. I'm going to be in approximately $81,000 in this particular project. Now, the other thing I want to break down is what is my projected profit. So what we do is we take the actual after repair value and we consider all of the costs associated with closing on the resale. So based on those numbers, I'll give you a quick calculation of my figures. That means that if we sold it for $109,000, we would probably net closer to $100,000. $740 in fact, to be exact. So again, once again, simple strategies here. We're in at $81,000. We're looking at a potential profit of $19,740. So that's our projected profit margin there. So for me to discern and determine whether this is a good investment or good risk to reward ratio, one of the elements that I'm going to do is just calculate my cash-on-cash return, which is basically dividing my return by how much I'm involved in the transaction, which means that I'm in the deal about 24%. So cash-on-cash, I'm in this transaction 24%. Now, what I have to also consider based on this quick analysis of the project is what is my exit strategy? And in our company, because we do so much volume, we have various types of exit strategies that we implement. One of them is our TV television model, which means that we reduce our price slightly in order to sell it on television and ultimately moves quickly. But in this particular case, because we're looking at a 24% cash-on-cash return, we understand this market and we know that there's a very strong retail buyer group out there that's looking for inventory that's been updated. We feel that basically listing it with one of our preferred agents is going to be the best way to sell this property for a top dollar. Now, he may actually accomplish higher, which is great. But I never look at a higher projection. I always look at what I feel the conservative projection for this transaction is. Based on these numbers and a 24% return with a listing that will probably take closer to 60 to 90 days in order to close, we feel comfortable enough that there's enough room in there for us to make that investment so that we can not only perform for our fund, but also for our office. And so this will be a great investment. In the near future, we're going to actually take you to the property so that you can see the type of improvements that we've invested on in our renovation budget in order to generate that value at $109,000. The properties that we exit at these price points are actually built in 2004, 2005, and on. So those are big factors to consider. Also, the reason why our rental budget for this particular house was higher was because we had to take into account the fact that since this property was built in 1977, and when we looked at public records, we saw that nobody had ever pulled permits to do a new roof, we have to automatically run in our figures that this property is going to need a new roof. And that's a factor that most investors forget completely about. But again, this is part of our due diligence And based on those figures, we felt that our rehab budget had to be higher in order to justify bringing the value higher. One of the other things too that we had to review in this particular section is that generally when you're looking at comparable sales to base your value on, you usually have what we call short sales, REOs, or what we also call retail. Okay? Now, when we're running our figures based on these particular transactions, it's very important that once you're having an argument about what value is, that you actually go to the transactions and see, were the properties that sold at this price short sales? Were they bank-owned properties? Or are these real properties that are being sold to end users? And if so, then we go a little bit further and we say, what kind of finish? What kind of rehab did they do to this particular property? Because at the end of the day, we're going to be competing with retail sales. So if they have granite countertops, if they have a lot of great improvements like backsplash, a different set of colors, we have to rehab the property to a standard that will compete with the marketplace. So based on these figures, and after running our assessment and running our final valuation based on retail comparable sales, these are the final numbers. The total cost into the project will be $86,500. The projected profit will be about $95,680, which is basically after we sell the property for the 104, this is what we're actually going to net after closing costs, leaving us with a total profit of about $9,180. The problem with this transaction is that even though it has a profit of 10%, those margins are too tight for us, because if there's one mistake that we make, or if there's an additional item that we were missing in our rehab that we have to cover, then our ROI drops significantly. So that's one of the reasons why, even though this project is positive, we are extremely cautious about our investments, and this project would not pass the muster.